Good morning, everybody. Hopefully you had a wonderful weekend. We've had some good weather in Minnesota, but we're back down to cold weather. So hopefully you're not experiencing what we are. So we'll go ahead and get started here. 5Q breakdown last week. These people are arguing about whose fault it was for hiring a bad advisor. Priceless. I mean, this is exactly what you want to hear a client do. So make sure if you didn't listen to last week's 5Q tape breakdown, you want to know or hear an advisor doing a perfect job, this would be a great tape for you to listen to. So identity theft. Do we talk about identity theft in our 21-point checklist? Yes, we do. Big problem or not a big problem in today's world? Big problem or not a big problem in today's world? Yeah, huge. So why as financial advisors do we talk about it? It's not our job, is it? Because what kind of advisor would I be if I didn't talk about it, right? So I want to give you a cool, and I gave this to you about 2 years ago. I want to remind you about this too, because this is a fantastic thing that you can give clients at a 21-point checklist. Just give it to them. And when you give people things at a 21-point checklist, what do they think about you? When you give things to your clients that cost you nothing and them nothing, what do they think about you? See, there's a catch-22, right? People don't want to work with you until they know that you care about them. But you can't really show that you care about them until they work with you. This is a great way to show that you care. So the Identity Theft Resource Center, here's a phone number, and this is just from online. So you can go to www.idtheftcenter.org. Go there, or they actually have an app that they can people can go to. So funded by the Department of Justice, free app for both Apple and Android, helps prevent ID theft and make it easier to deal with it when it occurs, lets you connect to an identity theft specialist using a free hotline or chat. So guys, are you all aware of this? Do you have this as your resources? Is this something that you give out or help put clients with or prospects with right up front? So it's a good idea or a bad idea to give people? What's it make you look like when you do this for a client or do this for a prospect? Yeah, an expert, a hero, exactly. So these are the kind of tools that when we can give somebody or give our prospects or give our clients things that cost us nothing and cost them nothing, but they didn't know it existed beforehand, what a way to show that we are providing value. For prospects, we can provide value even before they become a client. Does that make sense? Cool. Also, wanted to touch that we've added or changed. Missy's done a great job of changing the website, and so under Getting Started, it says Learn 5Q Start Here. Learn 5Q Start Here. So you may have remembered this is where you used to go when you would come on board. It would say Quick Start. Now it's actually it's still kind of a quick start for people coming on board, but it's also a great tool for you guys to use. So if we go to Learn IQ, let me bring the site up here a second. So we're at the site. We go to Learn 5Q here. And down here, this is a great thing for if you just are bored or you want to kind of review things. These are short videos. For example, 7-minute, 50-second video, overview of the site. Here's a 5Q system manual from start to bottom. Marketing overview, 20 minutes long. Meeting process overview, 10 minutes long. Agreement meeting training, 34 minutes long. How to fix a POA, 22 minutes long. Agreement meeting for all types of marketing. So no matter what kind of marketing you're doing, how you conduct your agreement meeting, 11 minutes long. Motivational interviewing and why we did in the 21-point checklist, 10 minutes long. So you see these are all short, quick things that you could look at. A video tip, what the end goal is for each of the 21-point checklist. That's a long one, 50 minutes. Morningstar, 5 minutes. 21-point checklist software, 33 minutes. How to ape, 8 minutes. Open-ended versus closed-ended questions and how to get really good at them, 13 minutes. So it goes through the drills that we can use to get really good at open-ended questions. For 15-minute drill, how to do a perfect 15-minute drill. The FIA presentations, sale overview, software overview, objections overview, and then extensive objection training, 50 minutes long. How to use testimonials, 2 minutes long. how-to for the how-to for epidemic marketing. So if you want to, if you're now starting to get involved with that, right there, step-by-step process from prospect to client communication guide. So this is a resource you can go back and short bits and pieces to make sure your skills stay high. Okay, so now we'll move on here. So right now, markets are hitting what? All-time highs, right? So it's a party. So again, the reason I'm still touching on, and I'm going to go very quickly through this, but the reason I'm still touching every couple of weeks or every 2 or 3 weeks on where we are with the market is because how easy is it to get sucked in that we're missing out on all the great things? Yeah, it's very easy. So we don't want that to happen. So here's where the Buffett indicator is. Holy moly. I mean, if you look at historically, how high is it? Even if you look at the last 20 years, how high is it? It's crazy. Here's the Schiller PE. Again, highest it's been ever. Looking at a future implied return over the next 10 years of a negative return over the next 10 years. So that tells you where we're at. 5 signs trouble in the stock market. Number 1 is an inverted yield curve. We had that 2 years ago, but right now, do we have an inverted yield curve? We do not. So one of the 5 signs is not saying that we have a problem. Now, but let's look at the other 4. Widespread complacency. Is there widespread complacency right now, guys? Do people think they can actually be hurt by a down market? Or do they think, yeah, the market might go down 50%, but guess what? Guess how quickly it'll come back up? If it goes down 50%, guess what? 6 months later, I'm going to be back to ground zero again. Is that the mentality that way too many people have now or not? I want everybody to answer that. Yay, yes, they do have that mentality, and no, they don't have that mentality. Yeah, because they have, human beings have short memory spans. So they think, hey, well, yeah, I saw, the market went down, didn't hurt me at all. So because it came right back. I'm back to where I was before. In fact, I'm better than I was when I went down here a year ago. I'm awesome. See, widespread complacency. Excessive valuations. Do we have excessive valuations right now, guys? Holy schmoly. I mean, again, if you just look at the 2 graphs that we showed you, we have unbelievably excessive valuations. Declining credit quality. Can anyone say mortgage problems going forward? Will there be any mortgage problems going forward throughout the year, by the end of the year? Yes. Why? Kevin says yes. David says yes. Why? Why will there be mortgage problems by the end of the year? What's ending by the end of the year? The stimulus and the suspended foreclosures. The suspended foreclosures ends, and we have tons of people who are behind in their mortgages. Guess what's going to happen? So we've got declining credit quality. Serious delinquencies. This is from the National Mortgage News. Well, you would think they would know, right? Serious delinquencies will soar in 2021 without more borrower aid. They're not giving more borrower aid. And irrational exuberance. Any news is good news. Does anybody know what the PE on Tesla is right now? Let's see how much you guys would follow this. What's the PE on Tesla right now? Tom says 160. Good guess. $250. Good guess. Yeah, billion, right, Howard? It's over 1,000. It's 1,096. The PE on Tesla is 1,096. So that means it would take 1,000 years of today's earnings to get that. Now, here's the thing to think about: is Tesla's basically been a phenomenal story. Musk created the electric car industry all by himself. But what's happened? He was the first to the party, the only to the party. But what's happening right now? What's Volvo doing? Toyota doing? Volkswagen doing? Yeah, everybody's now catching up. But what do investors think? Are investors analyzing that? Or they're saying, well, geez, if I would have invested in Tesla 10 years ago, I'd be a millionaire right now. Obviously, I better get in now so I can be a millionaire 10 years from now. Yeah. So out of the 5 signs of trouble in the market, how many do we have? Out of the 5, how many do we have? 4 of them. Yep, 4. So again, you don't pull all your money out of the market, but you should have a big chunk, especially the people we work with sequence of return problems. Right now has never been more dangerous for somebody, not for a 20-year-old, not for a 30-year-old, but for somebody who's late 50s, 60s, 70. What kind of danger are they in right now when it comes to sequence of returns? Huge danger. So today I want to talk about how you deal with a do-it-yourself investor. Do-it-yourself investor. Holy cow. David said that my mom just made 30% with no risk in her FIA. As good or better than the market? Well, I would say that is. Take that all day long. Awesome. Congratulations to you and your mom, David. So do-it-yourself investors. See, if I'm wrong, educate me, but don't belittle me. Who is to blame for do-it-yourselfer? Who do we blame, have the client blame? For do-it-yourselfer, who are they gonna, oh, very good, David. See if Nick's got it, David's got it. Who do we blame? Tom, Dale? I want everybody else. Who do we blame? Because, to get people to move, they got to put the blame on somebody, right? God, you guys are so smart. Everybody's got it. So if they're do-it-yourselfer, do we want them to blame themselves? No, they blame the entity they're working with. They blame the entity that they're working with. So first tell me that I'm smart, then help me. We're going to show you how we're going to tell them that they're smart, and then we're going to let them educate themselves. See, because here's the thing. When they're working with Fidelity, when they're working with TD Ameritrade, when they're working with whoever, they think I'm on my own, but are they on their own? Because what is TD Ameritrade, Fidelity, Charles Schwab, what do they all tell the independent investor? I'm an independent investor. I use TD Ameritrade and Merrill Edge to manage my own portfolios on the equity side. So what do they constantly tell me? We're here for you. That's right. We're here for you. So do-it-yourselfers are not doing it themselves. Here's a Vanguard. Vanguard is do-it-yourself, right? No. We give you advice in retirement, whether you're considering partnering with an advisor or looking for information you can use to manage your own portfolio. We have the help you need. See, they're not saying you're on your own. They're saying we're here to help. Fidelity, planning advice. As your needs in life change, so does the help you require. At every turn, we're here to help you plan, from investment strategies, complex wealth management needs, to manage your portfolio. We're here to help. See, they're saying what? That you're on your own, or you should work with us because we're going to help you. Yeah, it's saying we're going to help you. So with a do-it-yourselfer, can we point the finger at their discount brokerage with a do-it-yourselfer? Yes, because what are the discount brokers have said? We're here for you. We're going to help you. So can the discount broker say, not my job, your job? Can the discount brokers say, it's not my job? Well, they can say that, but is that right when they say that? Are they right when they say it's not my job, it's your? No, it's not right, because they've said, I will help you. See, you just said you're going to help us. You said it was your job. So when we look at DIY funds, passive versus active, let's look at Fidelity. Their index funds are at 0.04% expense. Vanguard's at 0.03. Their actively managed funds average 0.45. Actively managed funds in Vanguard is 0.75. So Fidelity, it's 10 times more costly to be in their actively managed than in their indexed. With Vanguard, it's 25 times more costly to be in their active versus their indexed. So if somebody's doing it themselves, where should they be? Should they be in the actively managed or should they be in the indexed? Yes, but what do Fidelity and Vanguard really push? They push their actively managed funds. Yep, they're actively managed. See, so do-it-yourself no load equals money manager. So these funds are this says what? They're being what? Managed. So are they using a money manager then? Yes. So what we're going to do with a do-it-yourselfer is we're going to use the risk-reward script. So Morningstar, get them to buy into Morningstar. Going to walk through the graph. Going to ask them if they want to take more risk for less return or less risk for more return. Had you heard about this before? Why doesn't your Fidelity wants you to know this? Why doesn't Vanguard point this out to you? Would it have been helpful to know this? Why didn't they tell you this? So why do you suppose they didn't want you to see this? Well, because I wouldn't have invested, and they would have, and they or Fidelity or Vanguard, whoever, would not have made as much money on me. And again, guys, how much more money is Vanguard or Fidelity making on them in the managed versus indexed? 25 to 75 times more. That's right. So we're going to go. What's this blue line? What's the story we use for the blue line? What's the story we use for the blue line? No cost? Yeah, but no cost what? What's the story? What's the thing that everybody can experience and relate to? Autopilot. That's good, Steve. Yep, Autopilot. But what's the story we use? Good job, Tom. Cable TV. So we get them to buy into Morningstar, and they say, yeah, no, it's third party. I agree with it. Then we get them to understand the graph. We say, so this is a graph. What does it say down here? Low risk versus low reward. What's it say here? High risk, low reward. So it means as we go this direction on the chart, we're taking more or less risk. We're taking more risk. This is return, and you can see this is a 3-year average. So it's not what the return is right now. It's what the return is averaged over the last 3 years. So it says here for low reward, which is a nice way of saying what? Return. Up here it says what? High reward. Yep. So it means as we go up this way, we get more or less return. We get more return. So this way we have more what? Risk. This way we have more what? Return. Yes. Now, have you heard of the S&P 500? Yes, I have. Blah, 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 blah. We go through that. We say, so guess how much it costs to invest in the S&P 500? Nothing. But before we get there, what we're going to say is, can I ask you a question? Let's say that your daughter moves into an apartment building, and they have 100 channels with the apartment rent. She gets 100 channels of cable for nothing. And then the cable company calls and says, hey, we're going to give you 40 channels for $50 a month. What are you going to tell your daughter to do? Take the 100 for free or pay $50 for 40 channels? Which one do you tell her to do? Pay for less or pay nothing for more? And what's everybody say? Has anybody ever gotten the wrong answer from a client on that or a prospect on that? No. It's easy. It's something they can relate to. So that's what this S&P 500 is, costing nothing to be in this. So this is like getting free cable TV. This is free rates of return with no cost. Now, can you take more risks in the market? This is the 500 biggest funds. If we invest in smaller funds, will the risk go up or down? They're going to go up, yeah. So as we go up here, they have indexes that are in small company stocks, medium stocks, growth stocks, tech stocks. And the more risk we take, the more what we expect. Return, yeah. But again, it costs little or nothing to invest in those indexes. Now, can we also take less risk in the market? For example, at the bank. And what are banks paying right now? Are they paying 7%? Or much less than that? Yeah, they're paying 0. So that's why it goes right off the chart, because this is 7.55%. But with banks, it's way down here. So if you have less risk, you're going to have less what? Return. But how much does it cost to be invested in the bank? Per CD or savings account? Nothing. So that's why we drive. So if we start at the S&P 500, we have 0 risk. We have more risk, and we draw this line. And what we call this line is the Autopilot Line, because does it cost us to invest in the bank? Well, no. Does it cost us to invest in the S&P 500? No. Does it cost us to invest in other indexes even if they're more risky? No. So this is the Autopilot, which means that if it's an index, is there a manager managing it, or is it just basically a basket of stocks that just sit there? Which one? Being managed or just a basket of stocks with no management? Which one? Basket or manager? B or M? Yeah, it's a basket. So if there's no manager involved, how much should they charge you for it? Nothing, yeah. So that's what this line is, the Autopilot Line, which costs you nothing to be in. It's like they're getting that 100, like your daughter getting that 100 cable channels for free. This is getting stock returns, safe returns, S&P 500 returns, more aggressive stock returns, all for free. Now, these other dots, guess what these other dots are? Do these funds look familiar to you? Yeah, so that's our stocks, yeah. So what it's saying is these are your funds. So are you taking more or less risk for this rate of return? So right here, is it getting a higher or less return than the autopilot? Higher or lower return than the autopilot? Lower, that's right. How about here? How about here? How about here? How about here? Higher or lower return? A lot or a little? And yet, you're taking how much more risk? For this return, you should be getting this much risk. Instead, how much risk are you taking? A lot or a little higher risk? Yeah, a lot. So a lot lower return. So if you were going to invest, would you want the highest return possible with the lowest risk? Or instead, would you rather want the lowest return for the highest risk? And which do you have right now? The highest return for least risk or the lowest return for the highest risk? Now, why did you invest in these funds? Did Fidelity kind of tell you that these are good funds to be in? Did Fidelity ever tell you that you could invest in the S&P 500 with their S&P 500 fund? See, now at this point, am I going to point the finger at them for being idiots, or I'm going to point the finger at Fidelity for not disclosing this stuff? Yeah, Fidelity. Well, if we look at it, here's the fund expense for the S&P 500. What is that? It's 0.04. What is it for the equity dividend fund? Oh, it's 0.75. So why do you think they didn't say, hey, you know what? You're a good customer of ours. You're a good client of ours. Have you considered investing with 10 times or 75 times less cost in the S&P 500 versus this? Did they ever approach you with something like that? And what's the client going to? The client at this point can say one of two things, which is, boy, I am an idiot, or Fidelity is scamming me. Which one are they going to choose? Especially with a couple. With a couple, which one is the guy who's managing the fund going to say to his wife? That he was an idiot, or that Fidelity was scamming him? What's the husband going to say? Or if the wife takes care of the money, what's the wife going to say? Yeah, they took advantage of me. Now that brings up something here. If they are a do-it-yourselfer and they're single, how many do-it-yourselfers do I ever try to work with? None. I don't work with any single do-it-yourselfers. Why? Because no matter what you say to them, they're going to have an excuse. See, the advantage of the wife is, can they make an excuse? No, because will she have it? She's lived with him for how many years? Decades. So she's going to put up with his excuses. So what we're doing here is we're going to give him an out. He can either throw Fidelity under the bus, or he can throw himself under the bus. And what's he going to choose 9 times out of 10? 19 times out of 20. 49 times out of 50. He's going to choose to throw Fidelity under the bus. Does that make sense? So, what are you getting for the fees you're paying, Mr. and Mrs. Client? What are they going to say? Do you want higher returns with less risk or lower returns with higher risk? And which one are you getting? Lower returns with higher risk. Did Fidelity ever point this out to you? Now, they said they're going to give you advice. Let's look at their website. Planning advice says needs change, so does help require every turn, help you plan from investment strategies. Did they ever, how'd they do on their investment strategy help, folks? Well or poorly? Wealth management needs. Oh, great. My wealth management needs is getting lower returns with higher risk. Is that good wealth management needs? How about managing my portfolio? Hey, great. They're helping me manage my portfolio with higher returns and less risk, or lower returns and higher risk. So what are you getting from Fidelity right now, folks? So here's the thing you should, and I'm going to throw Trish probably wasn't prepared for this, but she can get it to you. So here's the thing. You can have them invest, the do-it-yourselfer, have them invest in index funds, and there's 3 strategies, 3 investment strategies. There's the bridesmaid strategy. Missy's had great. Missy, have you had good luck with the bridesmaid strategy?
I have. It's worked great for me.
And how many years have you been using that?
Probably
years, right?
6 or 7 years, I'd say.
So there's the bridesmaid strategies, the MPY strategies. There's 3 strategies that you can help and do yourselfer with their funds using index funds. Now, I'll tell you, when I was an advisor, I had my Series 65. I was an investment advisor, but I managed nobody's funds. What I did is I gave them these strategies. So it's a way to use indexes with only 1 trade a year. Just 1 trade a year, because every year at the same date, it could be January 1st, it could be July 17th, but you choose 1 day every year. You look at your portfolio, and you make a trade. How many do-it-yourselfers could do that? 1 trade a year. All of them. Yeah. Now, here's the thing. If this is what S&P 500 looks, all of those 3 strategies, guess what? They perform better than the S&P 500 or the index itself. With 1 trade a year, better than the index itself. Now, it still has risk because you're in the market, but it gives you a higher return with less risk than the S&P 500. And guess what it costs the folks? Nothing. Nothing. So if you don't know what those strategies are, email Tricia, and she'll send you an email with magazine articles on those strategies. So what I used to do is I used to give people those strategies and say, you know what, you're a smart person, you know how to manage stocks, but here are 3 strategies that are far better and cost you far less. I only went after the fixed money. So when I showed them how they could perform better, and I didn't try to corral their money or strong arm them into moving their stock money, guess how easy the FIA sale became for me? Guess who my easiest people to sell were? Do-it-yourselfers. Why? Because I said, hey, let's move your equity money into one of these 3 strategies, saving you. You're only be paying 1/10 of the cost you're paying now with much higher returns. Because when we're saying that you get a higher return than the S&P 500, how much higher is that than these with less risk? So you see, so when I sold the FIA, it was much easier. I'm not saying you have to do that, but that's what I did. So even though I had my Series 65, I just gave them those strategies. So if you're not aware of what those strategies are, contact Tricia, and she'll send you an email with the strategies and how you conduct those. And guess what you look like? What do you look like to do-it-yourselfer when you do it that way on their equity side? Yeah, a pro, absolutely a pro. And also, what do you look like? You're trying a money-grubbing advisor who wants to get every single dime from them? Yeah, that's perfect, John. You're a hero and you're honest. That's exactly right. You're a hero and you're honest. Because should we really be charging them management fees for being invested in indexes? You could if you were going to manage those 3 strategies for them. And I had people say, well, will you help me manage those strategies? I could have charged them 0.5% a year to just make 1 trade a year for them. And if they wanted me to do it, I'd be happy to do that. But most of them said I can do 1 trade a year. Now, the other thing we have to consider is this: is that what if they have good funds? What if they're all the funds are good? Now, how often does that happen? Virtually never. But let's say that 1 in a million person comes in and they have all good funds. Well, okay, what are we going to do then? Going to just walk away from all the money? No, we're not going to get greedy. We're going to tell them that they're geniuses on the equity side. They're geniuses on the equity side. They've done a fabulous job managing that equity money. You got this. You are doing a good job of looking at all the data on stocks that are out there. So because how much data and information is there for do-it-yourselfer on stocks out there today, guys? A lot or little? How many services too much is right. Enormous amounts. So, and when you've talked to do-it-yourselfer managing their stock portfolio, yes, guess what? Just been through a fantastic decade, so they all think they're what? Like we said, on your block right now, how many investment geniuses are there on your block right now? I talked to one of my neighbors who invests his own retirement money, and he was telling me that guess what he said the PE was right now? Yeah, it's only like 19. Guys, What's the PE on the market right now? 19? Well, let's take a quick look. We're getting answers all over the place, so apparently we aren't in agreement. So let's just take a quick look at what the PE. So you understand the Shiller PE is the average over 10 years, right? The Shiller PE is the average over 10 years. What I'm talking about is what is the PE today on April 19th? Let's take a quick look. S&P 500 PE. What is it? 19? What's it say right here, guys? 42. So you understand the Shiller is the average over the last 10 years. This is the PE right now. How high has it been? Guys, how high is that? How high is that? That's crazy high. That's not even the Shiller PE. That's where we're at right now. So, but people think they're geniuses. My neighbor thinks he's a genius. And will he put up with me saying, did I correct him there and tell him he was an idiot? No, go look it up. No, because when you start correcting people, they're going to fight you. But they think they're genius, so I'm going to compliment them and say, listen, you got all sorts of information that tells you, and then you can go through and you can figure it out for yourself. You're a genius. Look at how well you've done. I'm going to compliment them on the stock portfolio. But if they have all their money in stocks and there are a couple, can we get the wife to understand that we don't want all of our money in stocks right now? Yes. So we say, so you got a handle, you got it, you got a handle on it. You're doing a fantastic job on the stock side, but on your guarantee side, I see that you have money in bonds. And bonds, how much information, how many are you getting on your bonds? See, there's bond valuations, different types of bonds. In fact, here's the types of fixed income securities are. There's treasuries, agencies' debts, agency pass-throughs, CMOs, CRA qualified mortgage pools, bank qualified, bank eligible, general market, taxable municipals, corporate bonds, SBA pools, money markets, non-agency residential mortgage-backed securities, commercial mortgage-backed securities, asset-backed securities, collateralized debt obligations, collateralized loan obligations. So how much information are you getting on these folks? And what are they going to say to that? A lot or none? None. See, fixed income securities are largely traded by dealers and traded infrequently. Data is therefore difficult to obtain. So it's not because you're not smart. You are smart. You've proven you're smart. You've done a great job on the equity side because you have the information. If you had the information, you could manage your bond portfolio. But do you have access to that bond information, Mr. and Mrs. Client? What are they going to say? No. So I've told them they're smart. I've told them if they had the information, they could do it. But they have to admit that what? They can't do it, not because they're dumb, but because they don't what? Have the information. So if you don't, now, because I'm in the industry, I have access to that information. See, so you are out in the desert when it comes to fixed securities information, bond information. You're in it, but I have access to it just because I'm in the industry. See, there's a large number of fixed income securities result in, and the reason we have to be concerned about fixed income securities, bonds, etc., is there results in differences in a number of index securities among fixed income indexes. Illiquidity costs and high turnover in constituent securities make it both difficult and expensive for fixed income portfolio managers to replicate a fixed index. So can they use, what this is saying is, can people just use a fixed index then? It's very, very difficult, not well. So can I make a suggestion? Again, if you had the information, I am very confident, just based on how well you did with the stock portfolio. Again, guys, am I going to make they've been lucky on the stock portfolio, but am I going to argue that, or am I going to pat them on the back for where they think they're geniuses? Argue or just pat them on the back because they think they're genius? I'm going to pat them on the back and say, so you got that, and if you know what, if you had access to the fixed side, I think you could do a good job there too, but do you have access to any information on the fixed side? No. So what I would recommend is, why don't you handle all the growth side, Let me handle with the safe side. And guess what the wife says at this point? Because does she want all that other stuff we've talked about in the 21-point checklist that we're going to help her with? Yeah, she wants all that stuff. So she's going to say, am I making a reasonable and a fair offer at this point? Am I being reasonable and fair at this point? Yes. And really, have I placated the guy who's managing the portfolio so that he thinks he's a big shot, and yeah, he'll go ahead and give me the safe stuff? Now, the great thing is, once they let me help them with the safe, when I go through the FIA presentation, what are they going to agree? What do they have to agree on? What's the bond FIA presentation? We have that chart, right? And what's that chart say? They should have more or less asset allocation, right, Nick? They're going to go through that asset allocation. So we're going to get a big chunk of this. Does that make sense? So we went from a do-it-yourselfer who we can't get to do-it-yourselfer. We're going to get a big chunk of the money because we're going to manage the safe side. So these do-it-yourselfers, we know we can get them to leave their current advisor, but now do we also know that we can bring on do-it-yourselfers? And the best thing is, who's likely to die first, the man or the woman? The man. So what's going to happen when the man dies? What's the woman going to say? I want to keep managing the equity side, or I'm going to move all the rest of that money to you? Move it. Does that make sense? So, do we have tools and a methodology to get do-it-yourselfers to move a big chunk of their money to us, and eventually all of it when the guy dies? So, was this a worthwhile reminder about the power of the system? Even when how many other advisors out there have the ability to go after do-it-yourselfers the way we do? None. There are not many. Well, if there are somebody, how are they doing it? By saying that they're smarter than the do-it-yourselfer? How does that work? It doesn't. Coolio. So you guys, thanks for being on today. We're going to end a little bit early. And go visit on the website that new Learn 5Q just so you get familiar with it and you can go back and check it out every once in a while. I appreciate you guys. You guys have a wonderful rest of the week, and we'll talk to you next Monday. Thanks, everybody. Oh, yeah, and Tricia, send Tricia an email if you want those money management techniques. Thanks, guys.